Very good morning, everyone. Everyone fine. Now, today actually the live session was supposed to be taken at 5:30 p.m. but due to some my personal work, I could not give the live classes at 5:30 p.m. So I came early. So if you are not able to listen class right now, you can listen the class as per the scheduled time, that is 5:30 only. Okay. So of course the video will be available in YouTube. You can listen at that particular time. Okay. Now the last class we have taken the questions from RTP May 2022 attempt. We have completed up to question number 10. I hope whatever we have discussed that you have understood. So can we continue with the question number 11 today? Yes. So come to question number 11. That question is related to India's 24. Very simple question. What is this question? That entity A owns 30% of share capital of entity B and has the ability to exercise significant influence over it. Means can I say entity B become an associate, so it is 30%, so it become B, so B is an associate. Entity B hold the following investment, that is 70% share capital, 70% share capital of its subsidiary C, okay sir, and 30% share capital of entity D with an ability to exercise significant influence. B has an associate what? B has an associate D, correct? Yes sir. Okay. Entity A transact with entity C and D, means now entity A is doing some transaction with entity C and entity D. Should entity A disclose this transaction as a related party transaction in separate financial statement? Also explain the disclosure of such transaction in the financial statement of C and D as related party transaction. Now everyone just try to understand. First we need to understand whether A and B are related party. So of course A and B are related party. So any associate will be a related party. This is as per para para 9b2, as per para 9b2 of India's 24. So can you say associate and the joint venture of reporting entity will be related party. So A and B are related party. Now as per India's 24, any subsidiary of an associate will be also related party. But any associate or joint venture of an associate will not be a related party. Means can I say A and B, this will A and B are related party, and with this A and C are also related party, but A and D are not related party. Means can I say any transaction with A and D are not supposed to be disclosed as related party transaction, but any transaction with A and C will be reported or disclosed as related party transaction as per the requirement of India's 24. Understood? Correct. Also explain the disclosure. So of course the disclosure will be two-way. If A is related to C, so C will be also related to A. So of course in the financial statement of C, the related party transaction with A will be disclosed. Similarly, in the financial statement D, such transactions are not required to be disclosed. Understood? Have you understood? Let's see what the answer has been given. I hope this is very simple. What they have given. Entity A should disclose its transaction with entity C in its A's separate financial statement. Entity C is a related party of entity A because C is the subsidiary of entity A, associate entity B. Entity A's management is not required to disclose entity A transaction with D in its financial statement. Entity D is not a related party with entity A because entity A has no ability to exercise control or significant influence over D. Correct now, because with the chain is always created to subsidiary. So if B is an associate, so associate of B is not a related party. Understood? Yes. Entity C is also required to disclose the transaction. Yes, entity is not required to disclose such transaction in their financial statement. Understood? Simple. Correct? Yes, sir. Let's come to next question. Question number 12. It is a question related to joint operation and joint venture. India's triplement means you need to identify whether the given arrangement is joint operation or joint arrangement. We all know that. Let us read the question first. For a joint arrangement, this is the solution. What is the question? Identify the type of joint arrangement in each of the following scenarios. X and Y Limited manufacturing similar type of mobile phone from a joint arrangement to manufacture and sell mobile phones. Under terms of arrangement, both X Limited and Y Limited are to use their own asset to manufacture the mobile phone, and both are responsible for their own liability related to respective manufacturer. So from the question given, it can be understood that both parties to the joint arrangement have have right to asset and obligation for their liability, and therefore can I say it is a joint operation, not joint venture. So in can I say first case it will be joint operation. I think you understood. Correct. And they have written also no separate entities created for the arrangement. So whenever it is unstructured, then so always it will be joint operation. Unstructured joint arrangement will be always joint operation. Okay, sir. Continuing with one above, what should be the classification of joint arrangement if X and Y Limited are both jointly controlled over the relevant activities of joint arrangement? One thing I have not read. Point number one. The arrangement also lays down the revenue distribution revenue from the sale of mobile phone and expense incurred thereof. X Limited, however, has an exclusive control over the marketing and distribution function and does not require the consent of Y in this respect. So can I say from the arrangement it can be understood that both party does not have joint control. Means Y cannot direct the relevant activities, so they do not have joint control. Therefore, it is not a joint arrangement. A question of joint arrangement will not arise. So it is not a joint arrangement only, correct? Now, point number two, continuing with one above, what would be the classification of arrangement if X Limited and Y Limited both jointly control all the relevant activities of joint arrangement, including the marketing and distribution functions? So, in this case, can I say it will be joint arrangement, and because it is unstructured and both parties have a right to specific asset and obligation for a specific liability, therefore, this will be a joint operation. Point number three. What would be the classification of joint arrangement if under terms of arrangement a separate entity is created to manufacture the mobile phone? Now, a separate entity is created to carry any structured joint arrangement can be joint operation and can be joint venture depending upon the facts and circumstances. So, as per the contractual term, it is understood that both parties have a right to asset and both parties have an obligation for liability. Therefore, it is a joint operation. However, you can also write down a alternative and say both parties will have a right to the net asset of arrangement, then it will be a joint venture. Correct? Yes, sir. Point number four. Continuing with the three above, the joint arrangement is a means of manufacturing mobile phone on a common platform, but the output of joint arrangement is purchased by both X Limited and Y Limited in the ratio of 50:50. The joint arrangement cannot sell output to third party. The price of the output sold to X Limited and Y Limited is set by both the party to the arrangement to cover the production cost and other admin cost of the arrangement of the joint arrangement entity. Now, if the activities of joint operation is designed such a way that they will provide output, if they will provide output to the parties and such that for the settlement of liability the joint operations are dependent on what parties, then it will be joint operation. So of course from the question, from the case, it is understood it is joint operation, not joint venture. Understood? Would your answer in point number 4 above be different if X Limited and Y Limited sold their respective share of output third party? No, answer will not be different because X Limited and Y Limited can sell their output received from joint operation third party. The answer will remain same. It will be a joint operation only. Correct? Yes, sir. What is point number 6? Assuming that in point number 4 above the contractual terms of arrangement were modified so that joint arrangement entity is not obliged to sell the output to X and Y but was able to sell the output third party. Now in this case the third condition means the third condition given under India's triple one will not be satisfied. Then now it will be what? Joint venture. Joint venture, because the output can be sold to third parties also. It means the joint arrangement is not dependent upon their parties for settlement of liability. Therefore, it will be a joint what? Venture. Understood this point? Have you understood this point? Point number 6? Yes, sir. It's simple. You can read the answer. Answer is given detailed way. You can read the answer. You will be able to understand. Correct? Okay, sir. Coming to the next point. So question, we have done question number 12. 12 completed. Now question 13 is a good question related to Ind AS 20 and Ind AS 109. A Limited is engaged in the manufacturing of certain specialized chemical. During the manufacturing process, certain wastewater is produced which is released by A Limited in nearby river. To reduce pollution of the river, the state government has introduced a scheme with the following salient features. If a manufacturer installs certain pre-approved wastewater treatment plant, the government will provide an interest-free loan. An interest-free loan means concessional loan. Concessional loan will be covered under Ind AS 20 and it will be measured as per Ind AS 109, and any difference between proceeds and the fair value loan will be considered as government grant equal to 50% of cost of the plant. Such loan is repayable to the government in 5 years from the date of disbursal. The manufacturer availing the benefit of this scheme must treat the wastewater of his factory using the specified plant before releasing it to the river. If this condition is violated, the entire loan should become immediately repayable to the government along with a penalty of 10 lakh. So a new question, this is totally a new question. In this question was not in ICAI study material. It's a good question, but similar question we have done. Correct now. Cost of the wastewater treatment plant to be installed to avail the benefit of the scheme is 50 lakh, means the grant will be 25 lakh. A Limited means the loan will be not grant, loan will be 25 lakh. A Limited decided to utilize this scheme because if it were to obtain the similar loan from bank, it would be available at a market interest rate of 12% per annum. So you can calculate the fair value of loan by applying 12% market rate of interest. Accordingly, A Limited applied for and obtained the government loan of 25 lakh on 1st April 2001. A Limited purchased and installed the plant such that it became ready for use on the same date. So it become ready for use on the same date, the depreciation will commence from that date. A Limited has an accounting policy of recognizing the government grant in relation to depreciable asset in proportion of depreciation expense. Means it can be understood that in this case government grant will be treated as deferred income because they are saying it will be amortized to PL in the ratio of depreciation expense. It has determined that plant will be depreciated over a period of 5 years using straight line method. In the month of March 2003, in the month of March 2003 means in the second year only, means 2001 2002. The first year is 2001 2002, second year is 2002 2003, means in the second year only government official conducted a surprise audit and it was found that A Limited was not using the water treatment plant as prescribed. Accordingly, on 31st March 2003, the government ordered A Limited to repay the entire loan along with penalty. So it will be repayable. A Limited repaid a loan with interest and penalty as per the order on 31st March 2003. Measure the amount of government grant as on 1st April 2001. Determine the nature of government grant and its accounting treatment principally for the year ended 31st March 2002. Also determine the impact on PL, if any, on account of revocation of government grant on 31st March 2003. Good question, I will say. Good question. Good question, but simple. So in this, first we'll calculate what fair value of loan. Fair value of loan will be equal to present value of 25 lakh at market rate of interest for 5 years. So you can see fair value of loan is 25 lakh multiplied by present value factor at 12% for 5 years. So it will be 0.567. So it will be 14 lakh 17,500. Means this is the amount of loan. Now 25 lakh minus 14 lakh 17,500. So balance is what? 10 lakh 82,500. This will be what amount of government grant. So what journal entry will do? On first date, bank account debit to deferred grant income is deferred government grant to loan account. You can see this. Now in this will apply Ind AS 109 and in this will apply Ind AS 20. Correct? And of course on the same day they purchase the property plant and equipment. So we can also pass one more journal entry. Property plant and equipment account debit to bank and they are purchased at 50 lakh. In this will apply Ind AS 16. Ind AS 16 means depreciation will be charged for how many year? 5 year. because it is SLM method. So can I say this deferred income will be also amortized to PL in the same ratio, in the ratio of depreciation? Correct? Yes, sir. You can read this. Now you can see on 31st March 2002, depreciation to PP is what 50 divided by 5, that is 10 lakh, and deferred grant will be also transferred to PL on SLM basis, means in 1 is to 1 is to 1 is to 1 ratio, that is deferred government grant to PL. You can see they have done how much, divide by 5 is equal to what, 2,16,500. Very simple. Correct. But can I say we need to also pass one more journal entry on loan, means interest expense will also come. Interest expense to loan, interest expense to loan. So interest expense will be calculated on 14 lakh 17,500 into 12%, that is coming 1 lakh 70,100. So 1 lakh 70,100, that journal entry also we can do 1 lakh 70,100. Understood? Have you understood? Correct. Now coming to the 31st March 2003, can I say 1 second will pass jana entry? 1 second will pass jana entry of depreciation to depreciation account debit to what? PP 10 lakh. 1 second the grant will be transferred to PL to the extent of 2 lakh 16,500. 1 second interest expense will be recognized. Correct? Yes, sir. Means we need to first calculate the amortized cost of loan. We need to first calculate the amortized cost of loan. So if you prepare one amortization schedule loan, you can see this is the closing balance of loan, and you need to also find out unamortized portion of deferred income. The unamortized portion of deferred income, this minus this and then this minus this will be 6,49,500, and amount to be refunded is 25 lakh plus 10 lakh. So total amount to be refunded is 35 lakh. So what journal entry you will do on the date of refund? Can a journal entry what? Ki the total amount to be refunded is what? 35 lakh. So to government grant payable will be 35 lakh. Correct. Can you say now first you will debit loan account? Loan account debit will be the closing balance, that is 17 lakh 78,112. Then you will debit deferred government grant account. Deferred government grant is 6,49,500, and the difference will be transferred to PL. The difference will be transferred to PL. So you can, difference is 35 lakh minus 17 lakh 78,112 minus 6 lakh 49,500. The difference becomes 10 lakh 72,388. Correct. So you can pass one compound journal entry. They have given two journal entry, first for 25 lakh and then for 10 lakh. But you can pass one compound journal entry also. Simple. I hope it is very simple. Understood? Have you understood this part? Bolo. Got it? Good question, I will say. Yes, sir. Coming to the next question. Then next question is on India 32 and India's 109. This is also very simple question. ABC Limited issued 4% 1 lakh optionally convertible preference shares. Optionally convertible preference shares at a face value of 100 per share on 1st April 2001, and these are redeemable after 5 years, that is on 31st March 2006. Dividend is non-cumulative. Dividend is non-cumulative. So if dividend is non-cumulative, they have said optionally convertible preferences. I always say that whenever it is option and option is given to the holder, it will be always a compound financial instrument. However, can I say optionally convertible preference shares, principal amount will be initially classified as financial liability, and because the dividend is non-cumulative, so non-cumulative means, can I say dividend portion will be equity and option has been given, that will be also equity, means this will be a compound financial instrument. Yes, sir. Each preference shares entitle the holder to 10 equity shares, and each preference shares entitle to the holder to 10 equity shares, and the preference shares are optionally converted by the holder at any time until maturity, means it can be converted into equity at any time until maturity. How will the preference share be classified as initial recognition, assuming that comparable instrument carries a market interest rate of 7%? Provide journal entry for year 1. Will the classification be changed subsequently in case there is a likelihood that OCPS will be encased at the end of maturity period? No. Can I say liability amount will be paid? Correct now. So if OCPS will be encased at the end of maturity period, I hope it is very simple. You need to first find out what? The fair value of loan. So in this case, the fair value of loan will be what amount? Correct. So can you say calculation? If you see the fair value of loan will be the present value of principal amount, redemption value. Correct now. Redemption value is what? 1 lakh. It is redeemable at par into 100. So if you find out present value at 7% market rate of interest, it is payable after 5 years. It will be 71 lakh 29,862. Why dividend has not been considered for contractual cash outflow? Because dividend is non-cumulative. Non-cumulative means there is no obligation to pay any dividend. Therefore, it will not be considered for financial liability component. Means the fair value liability component will be 71 lakh 29,862. So what is the fair value of equity component? Fair value of equity component this minus this, that is 28 lakh 70,138. Understood? So what journal entry you will do? Bank account debit to OCPS financial liability to OCPS equity, and this amount will come. On financial liability, can I say you will charge interest expense at the rate of 7% by using EIR? So interest expense account debit to OCPS, this amount will come. The first year journal entry they have asked, can I say if suppose they are converted before maturity, so only what you need to do, the financial liability, the amount will be transferred to our equity. So whenever the option is exercised by the holder to convert to the equity shares, so on that date the journal entry will be OCPS financial liability with carrying amount, and this will become equity. This will be transferred to equity balance on the date of exercise of the option. But suppose it is not converted into equity shares, then it will redeem. The journal entry will be financial liability, and that amount will become automatically 1 crore. Correct. To what bank? That is 1 crore. Understood? You can see the amortization table. You can see the at the end it will become what? How much? 1 crore. Understood? Have you understood this point? Correct? Yes, sir. Simple. Simple question. Come to the next question. Then the next question is for India's 101. This is a very theoretical question. Let's see what is given. GG Limited is a listed company. Prepays financial first India's financial statement for the year ended 31st March 2003. The date of transition is 1st April 2001. 1st April 2001 is the date of transition. It is the date when opening India's balance sheet will be prepared. The functional and presentation currency is rupees. The financial statement as at and for the year ended 31st March 2003 contain an explicit and unreserved statement of compliance with India. So they have given a explicit and unreserved statement of compliance of India's. Okay, it means can I say for this year it will be first India's financial statement. Previously it was using Indian GAAP. Okay, it has already published its first interim result of quarter 1, quarter 2 and quarter 3 of 2002-2003. So they have already published the interim finance report based on India's only in accordance with India's 34 and India's 101. The interim finance report included the reconciliation of both total comprehensive income and of equity that are required by India's 101. Since issuing the interim finance report, its management has concluded that one of the accounting policy choices applied in the interim should be changed for the full year. How should the GG Limited deal with the changes in accounting policy under India's framework? Now, just try to understand what India's 101 says, that subject to certain exception and exemption given under India's 101, the accounting policy whatever used for first India's financial statements which has been used for opening India's balance sheet should be used for the subsequent year also. Means there should not be any change in accounting policy. Subsequently, there is any change in accounting policy, so can I say it will be as per the requirement of India's aid. Correct now. But if suppose they have used some accounting policy for interim financial report and that they want to change in the first India's financial statement, so that can be changed, but a disclosure is required for that. A disclosure is required for that change. Understood now? As per the requirement of India's 101. What the answer is given? Let's see. You can see answer what they have given. First annual India's financial statement are prepared in accordance with the specific requirement of India's 101. Okay. subject to certain specified exemption and exception. That only I have said. Ind AS 101 required the entity to use same accounting policy in opening Ind AS balance sheet and throughout all period presented. Correct. This override Ind AS 8 requirement for disclosure about changes in accounting policy do not apply in the entity's first Ind AS financial statement. So Ind AS 8 is not applied in the first Ind AS financial statement. GG Limited should include an explanation of change in accounting policy that it has made since interim financial report in notes to annual financial statement in accordance with Ind AS 101. That only I have said only a disclosure is required. A disclosure required, you can read. I hope you have understood. Correct? Chalega. So this is a theoretical question. Got it? Yes, sir. Coming to the next question. Ind AS 102. Already this was also a part of previous RTP. Same question has been given. New Age Technology Limited has entered into following share-based payment transaction. On 1st April 2001, New Age Technology decided to grant share option to its employee. The scheme was approved by the employee on 30th June 2001. 30th June 2001, New Age Technology Limited determined the fair value of share option to be the fair value of equity shares on 1st April 2001. So in this question they have asked grant date and the measurement date. Grant date is the date when the both the party approved to the arrangement. Both the party means entity and the other party. And the measurement is that when the fair value of grant is measured, fair value of option is measured. So in this case, can I say the grant date is what? The grant date, the scheme was approved by the employee on 30th June. So grant date will be 30th June and the measurement date will be also on 30th June. Correct. So New Age Technology Limited determined the fair value of share option to be the value of equity shares on 1st April 2001. 1st April 2001. No, it will be 30th June 2001. Correct now. What the answer has been given, check करेंगे. You can see 30th June 2001, 30th June 2001. So what is the grant date? The date at which entity and another party agree to the share-based payment arrangement. Measurement date is the date at which the fair value of equity instrument granted is measured for the purpose of Ind AS, means as per the requirement of Ind AS 102. Correct? Understood this? First point, have you understood? Second, on 1st April 2001, New Age Technology Limited entered into a contract to purchase IT equipment from Bombay Software Limited and agreed that the contract will be settled by issuing equity instrument of New Age Technology Limited. New Age Technology Limited received IT equipment on 30th July 2001. The share-based payment transaction was measured based on the fair value of the equity instrument as on 1st April 2001. So in this case, can I say the grant date is the 1st April 2001, but the measurement date will be date when the goods was received. Understood now? So when the goods was received on 30th July. So measurement date will be 30th July for non-employee share-based payment. So for non-employee share-based payment, measurement date will be the date when goods are received, when the goods are delivered. Understood? Let's see what the answer has been given. So you can see grant date is 1st April, but the measurement date is 30th July. Got it? Yes, sir. Then next question, next part. On 1st April 2001, the New Age Technology Limited decided to grant is the share option to its employee. The scheme was approved by the employee on 30th June. The scheme was approved by the employee on 30th June. Okay, 30th June. The issue of the share option was, however, subject to the same being approved by the shareholders in the general meeting. So approval is required. The scheme was approved in the general meeting on 30th September. So this become granted. The fair value of equity instrument measuring on the share-based payment transaction was taken on 30th September. So this will be only measurement date. For employee share-based payment, grant date and measurement date are always same. Correct now. Grant date and measurement date are always same. Let's see what the answer has been given. You can see the grant date is 30th September, measurement date is 38th September. Understood? Have you understood Ind AS 102? Got it. Then coming to Ind AS 108, this is the very simple question. They have given what? All the information about segment sales, segment asset and segment result. You need to find out which segments are reporting segment, which segments are not reporting segment. So 8 segments are given: A, B, C, D, F, G, H. Information they have given: external sale, internal, inter-segment sale. So to find out reportable segment, you will take the total segment sale. That is, this information is important. Then segment result they have given in terms of profit, in terms of loss. then segment asset is given in total. Identify which of the above segment out of A to H would be considered as reportable segment. It is very simple. Let's see the solution only, because this is super easy question, correct? So you can see we'll first find out what total sales 600, then we'll find out percentage total sales means 100 by 600, 315 by 600, and any segment which have 10% or more than 10% of total segment sale, that will become reportable. So this is reportable, this is reportable, other are not reportable. Coming to segment result. So whenever there is segment result, first we need to find out seg first we need to find out the segment result in terms of profit, then we need to find out segment result in terms of loss, then we'll find out whichever is higher in absolute term, and that will become benchmark. So you can see profit, then segment loss, and you can see the total of segment loss is more than segment profit. Therefore this will become benchmark to find out what, to find out percentage, to segment loss, correct? Now then you'll find out total means you'll do 5 by 100, 90 by 100, 15 by 100. The percentage to segment loss you can find out, and you can see any segment, which has 10% more than total segment result. Understood? Correct. Total segment result, which can be calculated either in terms of profit or in terms of loss, whichever is greater in absolute terms. So you can see in this B and C are reportable. Yes, sir. Then criteria 3 is what? Criteria 3, it will be criteria 3. 10% more than segment asset. So segment asset is given very simple percentage you can find out, and you can, this is reportable, this is reportable, this is reportable. So from the entire 3 point we can understand A, B, C, D are reportable. A, B, C, D are reportable. But there is one more clause that whatever external sales are reportable in reportable segment, that should at least constitute 75% of total entity's revenue. You need to find out external sale of ABCD. External sale of ABCD is given 0 to 55, this 280. What is the total external sale? 405. This is coming 69.147, but it should be 75%. It will be more. We need to identify additional segment to be reportable segment, that will be decided by the management. So you can include any segment as what? Additional segment, additional reportable segment as per the requirement of the question. Understood? Have you understood? Hence, in the above scenario, additional operating segment need to be identified as reportable segment till the 75% test is satisfied, even if those segments do not satisfy the quantitative threshold limit. Understood? Simple. Correct. Simple question. This type of question we have already done in class. Then, coming to next question, India 38. D Limited is a leading publishing house purchased copyright of a book from its author. So the question related to intangible asset for publishing the same. As per the terms of the contract, if D Limited chooses to make the payment upfront, then copyright consideration will be 80 lakh is to be paid, which is in line with the general practice in such arrangement. However, the contract also provided that in case D Limited chooses to pay consideration after 2 years, then it will be required to pay 1 crore. At what value the intangible assets will be recognized as per India's 38. So it means if it is paid immediately, then cost price will be equal to cash amount paid means 80 lakh. But if it is paid after 2 years, so it becomes deferred settlement terms. In that case also cost price will be equal to cash price only. Cash price is equal to cash price equivalent means can is the present value of all future payment, which will be equal to 80 lakh only. And the difference between 80 lakh and 1 crore, that is 20 lakh. 20 lakh will be recognized as an interest expense over the period of 2 years. Unless it is covered under India's 23. Means if it is covered under India's 23, it can be capitalized also. Otherwise, it will be charged to PL as an expense over 2 years. Understood? Very simple question. 18. I hope no explanation required. Question number 19. XYZ Limited sells goods to its customer with a promise to give a discount of 5% on list price of the goods, provided a payment are received from the customer within 15 days. Correct. XYZ Limited sold goods of rupees 5 lakh to ABC Limited between 17 March 2001 and 31st March 2001. ABC Limited paid the due by 15 April 2001. Means within the time limit with respect to sales made between 17 March to 31st March. Financial statement were approved for the issue by the board of directors on 31st May state whether discount will be adjusted from sale at the end of reporting period. Correct now. So of course, can I say it become an adjusting event? Some discount was given, means there was some variable consideration, and can I say it is now confirmed before approval of financial statement. Yes, the customer will avail the discount. Correct. It means now the transaction price will be equal to what? Transaction price will be equal to 5 lakh minus what? 5%. Minus 5% adjusting event. It is an adjusting event. Let's see what the answer has been given. Check करेंगे. Let's see what the answer has been given. You can see if the consideration promise and contract include a variable amount, an entity shall estimate the amount of consideration to which the entity will be entitled in exchange of transferring the promised goods and services to the customer. In the instant case, the condition that sales have been made exists at the end of reporting period and the receipt of payment within 15 days after the end of reporting period before approval of financial statement confirm the discount to be provided on those sales. Therefore, it is an adjusting event. Accordingly, XYZ Limited should adjust the sales made to the ABC Limited with respect to discount of 5% of the list price of the goods. Correct? Yes, sir. 19 also done. Last question of RTP. Last question is very simple. Already a similar question is given in previous RTP. Let us read. Question 20. On 1st Jan 2001, entity purchased an item of equipment 6 lakh, including 50,000 refundable purchase tax. Means 6 lakh will do minus 50,000 because it is refundable, so it will not be included in cost price. In addition, the entity has to pay 5,000 in loan raising fee to the bank. The loan is secured against the equipment. In addition, the entity has to pay loan raising fee, means it is a transaction cost, and transaction cost for any loan will be deducted from the amount of loan proceeds. So this will not be capitalized. Correct? Yes, sir. Capitalized the cost of property, plant and equipment. In Jan 2001, the entity incurred a cost of 20,000 in transporting the equipment to the entity site. So this 20,000 will be capitalized. Yes, sir. And 1 lakh in installing the equipment at site. So this 1 lakh will be also capitalized. Yes, sir. At the end of equipment 10-year useful life, the entity is required to dismantle the equipment and restore the building housing the equipment. The present value is given. Thank you very much. So this will be also capitalized. Yes, sir. In Jan 2001, the entity engineer incurred the foreign cost in modifying the equipment so that it can produce the product manufactured by the entity. So the modification cost will be capitalized of 55,000 plus 65,000 plus depreciation. So 55,000 plus 65,000 plus 15,000. So this will be also capitalized. 1,35,000 will be capitalized because this is incurred to bring the asset in its working condition. Yes, sir. In Jan 2001, the entity's production staff was trained in how to operate the new item of equipment. Training costs incurred. Training costs included cost of an expert and labor. So training cost will not be capitalized. Training cost will not be capitalized. Correct now, because this is not directly attributable cost. In Feb 2001, the entity's production team tested the equipment and the engineering team made further modifications necessary to get the equipment to the function as intended by the management. So of course this will be capitalized. The testing cost, the following costs were incurred. Material net of 3,000 recovered from the sale of scrapped output 21,000 plus 16,000. So 21 plus 16, this will be capitalized. So 37,000 will be capitalized. Yes, sir. The equipment was ready to use on 1st March 2001. However, because of low initial order level, the entity incurred a loss of 23,000 and on operating the equipment during the month. So any initial operating loss will not be capitalized. Initial operating loss will not be capitalized. So this will not be capitalized. Thereafter, the equipment operated profitably. What is the cost of the equipment at initial equipment? Let us calculate the cost. The cost will be 5,50,000 plus 20,000 plus 1 lakh plus 1 lakh plus 1,35,000 plus 37,000. So it becomes 9,42,000. Let's check what is the answer. 9,42,000. Check करेंगे. 9,40,000. We have done correct, but you need to give explanation. Whenever this type of questions come, you can see the explanation is given. Loan raising fee offset against the measurement of the liability, transportation cost, directly attributable expenditure. Then these all are given. Then preparation cost, training cost, recognized as an expense in PL. The equipment was capable of operating in the manner intended by the manager without incurring such training costs. Means this is not a directly attributable cause this reasoning should be also given for this type of questions, correct? With this, all the question of RTP is covered, all the question I have taken into consideration, correct? Understood? I hope this time RTP whatever questions were given was very simple. There was no such question where explanation was required. Only there was one mistake in India's 115 question where the explanation was required. However, other questions were very easy. You can do it by your own. Understood? Correct? So we'll meet once again in one more live session. Means not tomorrow. We'll meet on what 4th. In that we'll discuss the ABC analysis and some important question from examination point of view. Already I have given expected question. If you want we discuss any question from your point of view, you can message me. We'll discuss that question on that day. Chalega? Understood? Have you understood? Okay, sir. For today, this much only. Thank you very much. We'll meet tomorrow. Till then, we will meet next day. Till then, bye bye. Take care. Enjoy your remaining day. Bye bye.